So now we'll turn to some of the economic data and you look at what is some of the leading indicators, what are some of the problems that we're seeing, some of the benefits, some of the good things that we're seeing, and what does it mean, and kind of putting it all together. And before we do that, again, please like, share, subscribe. Your support is appreciated. And we have our end of year report, which we can't push or highlight how important we think it is and how companies have told us they think it is to helping with their corporate planning and really their investments going into the new year. So now when we look at the U.S. manufacturing input prices, this is, again, the inflation side of when we're seeing those prices get pushed through and be accepted, because obviously there's not much choice, but we're seeing the rally in prices where now, again, anything above 50 is expansionary. We're at 65. Now, remember, anything between 52 and 48 is kind of like holding firm, but I mean, this is growth. This is real input prices going up. And it's something that's being recognized overall. But when we look at output prices, what is actually being charged? And again, these are things that are continuing to shift higher. This is becoming a much bigger issue as we continue to see this driving up and being an overarching problem, and just looking at some of the different components, like leading index from last week was slightly up. So the expectation was 0.5, came in at 0.6, but it's down from the previous 0.8. Then we have Chicago Fed National Activity Index was supposed to be 0.75, came in at 0.27. Again, these are things that are just slowing down. Like, the consumer confidence was supposed to be 97, came in at 88.6. These are things that we're continuing to see. Like Richmond Fed Manufacturing Index, which we'll go through more, was expected at 11, came in at 19, but let's break that apart and what does it mean as we go forward? Because when we look at spending by individuals receiving unemployment has fallen to its pre-pandemic spending levels following the expiration of the 300. That comes back with the supplemental benefits being picked back up. But just as we look forward, you're not seeing the same type of acceleration. So we're seeing prices going up, which is going to eat into the additional money coming through. So you're not going to see the same type of bang for your buck. You're just going to try to hold the line here, which again, why we remain so concerned and why consumer confidence is waning, where we already knew we were getting some sort of stimulus. The question was always going to be, what does that stimulus look like? And do we get any type of benefit as we go forward? And that's where we look at consumer confidence index continues to fall, continues to be under pressure, while the S&P index surges to all-time highs. And just look at the way this just typically they move in similar directions. I'm not saying they have to be mirror image or one on top of the other, but this is one of the widest distributions we've ever seen as the market continues to surge to all-time highs, as the consumer remains significantly concerned across many metrics at this point. And really, Chapter 11 pace slowed, but again, it was still the worst December since 2011. And this looks to, okay, if I'm filing for bankruptcy, what bills am I not paying? What do I have in liabilities versus receivables? Are people going to get pennies on the dollar for bills outstanding? So this is a reverberating effect. And these are things where, as we highlighted in the previous segment, small businesses are getting impacted the most. We're seeing, slowdowns, hours work going down, revenue going down, which again is going to impact the amount of Chapter 11, which we think will pick back up as we go into January, as we do have a big slug of debt that has to be rolled or changed starting in March, which is going to be a problem as we head into the remainder, the first quarter of next year. Again, back to GDP growth. What does that look like? But when we look at different areas, because what about the UK? And when we look at the UK, stocks of purchases, again, things have increased in the UK, not because things are so much better. It's just they're trying to bridge a gap for British exit. And we'll talk about that more in the next segment. But this is something where sometimes PMI data can be a little too aggressive just based on what are people preparing for. And this is an example of people are preparing for a rocky British exit, which we've already seen as it was supposed to be solved 4.5 years ago. So again, these are things that are a problem. So you have to take a basket approach with some of this data. And let's take what the Fed is saying. So FOMC is this is the dots, which I love. I always find funny. To me, I could give this to my kindergarten, my daughter's kindergarten class, and ask them to draw funny lines. And here, the expectations is that we're going to have monetary policy be free for through 2023. And if things remain more problematic, or it's going to take a big surge in inflation to see that change. So obviously, this is something that we should expect to see fairly loose monetary policy, especially as we have significant impasses at the at the fiscal level, even though things continue to be at an impasse, but yet market doesn't care, even though stimulus remains elusive, as they have to now send back the bill that was sent back from Trump to try to get more money, and it will fail in Congress to get the additional was it $1,400 in payments. So here, public debt. Speaking of more money, public debt is now at 125% of GDP in developed economies. We have now taken out the World War II peak. On the emerging economy side, it's at the highest ever, taking out the recent peak before the 1980 debt crisis, which was 65%. Again, just trying to highlight the issues that are sitting out there, just landmines that at some point they'll matter. Where it does, and the reason why we keep talking about GDP is because a lot of this is against GDP expectations. So if GDP gets worse, these numbers go higher. And that's why we continue to talk about GDP problems, because the percentage to GDP, again, growing into, not being able to grow into it, because there's just a lot of problems, a lot of issues that are going to be consistent and persistent in the market as we do come off into the close, which, just means that we'll rally in the aftermarket. But Chicago Fed, again, this is looking at some of the drivers, and we see the growth trend is slowing, with less and less driving some of this growth, which is again putting that pressure, which is why as we look into Q1, that's why we think we're going to see some of this continuation, as pressure remains a problem as we head into the end of the year. And the consumer confidence, as we keep talking about, Richmond Fed saw an increase of 19 versus expected 11, with new orders rising, but conditions and expected new orders going forward deteriorating, going into a contractionary level. Again, looking forward, so the numbers look good, but the expected numbers in the future have gotten worse. And that's because the consumer confidence is continuing to get softer and softer as we continue to see pressure across the board on general spending. And this is just looking at business conditions. The view that business conditions, again, small businesses, a lot of these individuals working at small businesses continue to get concerned, seeing pressure, seeing these issues coming down. And that's why the pressure is getting pushed. And again, we're at levels that we haven't seen since 2013, 2011, which is, again, the business conditions continue to deteriorate, which just means that the recovery will be slower going and just be a bit muted. And then when we look at the slower progress ahead, credit applications approved, rejected have gone negative. So that just means that we're getting less approvals on credit applications, which is slowing the leading index, which is slowing the confidence and the coincident index, with real GDP again starting to slow. That's why we, at the very first segment, we talked about the slowing GDP components and why we think the fixed investment side is going to slow and the consumer spending will remain under pressure, because this is where we're seeing the slowdown. But the Fed is buying debt with the idea that credit applications will get approved and we'll see more credit into the system, and we're not seeing that. This is why we remain concerned, because we're just not seeing that really carry through. But what are we seeing? No of existing home sales, weaker than expected at 6.69 million, which is a negative 2.5% versus 6.7. It's the first drop in 6 months but again, surging prices, record low supply is constraining that high demand, but unfortunately may continue to put strain on first-time buyers, which again is looking at what does that next segment look like, because when we look at the most recent data which came out today, so here we have new home sales. They were expected to be at 995,000. They came in at only 841,000. New home sales month over month were expected to be down 0.5%. They were down 11%. Coming full circle, where we had people coming in, they had a lot of money to put down. We saw 20, 30% put down. Now we're starting to see some of that slow. We're starting to see, again, people with 760 or greater on their credit score were the buyers. There's only so many of them. Those are starting to go away. The pressure continues to mount on how can we get some of this housing into the market. But the share of GSE loans with appraisal waivers by origination month. So can you get an appraisal waiver leveled off somewhat this month? So if my house doesn't appraise, there's a waiver where we'll still issue the mortgage anyway at the rate that we wanted. I had problems back in 2013 when we bought our first home, just because we were the first wave of people to really be buying homes. And in order to even get into the conversation, your initial offer had to be asking price. And we ended up settling for about 35,000 over asking, but then it didn't appraise because they were using homes that were sold, similar during a period of slow purchasing. So prices were down. And I tried to explain, no, well, the market is coming up to meet us, and we're at the first wave. So you're going to use my home as a means to rationalize other people's elevated numbers. So I'm the one that gets screwed at the beginning, and then you're going to someone else is going to get the approval. And obviously, I may be level-headed and calm on these shows, but I have an Italian temper, and that came out and wasn't a pretty situation. But again, you live and learn, and I'm now 36 versus when I was in my early 30s when this happened. So you age and mature and handle things differently. But here you can see again some of those resulting in a slight net increase. But again, some of these waivers are starting to cool as there's concerns that the market is starting to overheat. Prices are going to start to normalize and come down as we start getting a slowdown in new price increases overall. And that's why when we look at U.S. housing activity, permits still remain elevated, starts remain elevated as people try to meet this new demand. But again, this is the one that we keep coming back to, because not only is confidence going down, expectations are going down, present condition views are going down. These are things that are going to continue to weigh on what kind of activity do we see. And just this is going to put into perspective why. Well, food insecurity in the U.S. hit a pandemic era record last week. And I just want to pause on this for a minute, because doing research for another show and for another report, we're seeing food banks that are bare. I mean, so this is a good time to say, if you have the extra money, please give to your food bank. Your local food bank needs your help. There's the second largest food bank in Florida have been bare for 2 weeks. We're seeing food banks run dry because people, again, if we're coming up on 13% of the U.S. population are people reporting they sometimes or often do not have enough to eat in the past 7 days, which is why, as food banks are the fail-safe, as they run out of food, this number will go higher. This is a big problem when we think of people getting back to normal and spending, and that's why we do need stimulus. We need something, but it's just a shot in the arm because we're not seeing the jobs. We're seeing the food bank lines get exponentially longer, which is again sad as the market goes higher, even though people have less food, and it's unfortunate going into the holidays. So again, if you have the money, if you have the spare food, please give to your local food bank, because this is a real problem hitting real Americans, and we need to take care of our own. I mean, there's no other way to say it. We're Americans. We have to come together, put aside the issues. We need to help each other. And this is just, again, that example, because this number will get worse. And I don't see it getting better over the next few months. Now, the share of loan applications that are adjustable rate mortgages, again, we're starting to see people lock in the lower rate, because why not? If you have the ability to take in 2% money, I'm telling you to take that money. Take the money at 2%, because if it goes lower, refinance. But there's a good chance it stays here or goes higher. And this is a good time to lock that in, because you may not get that same chance ever again. And that's why when we look at the headline CPI, it's finally starting to pick its head up as expectations for 2.5% continues to move up. And we're seeing that across the board. And we're going to kick off the next segment looking at US dollar and euro expectations, because inflation picking up is a bigger problem. We're seeing the prices going up. We're seeing some of those components again, we're seeing the personal spending going down, jobless claims remaining elevated, consumer sentiment getting hurt, and just actual personal consumption going down. And these are the problems that, again, are going to persist into Q1, into 2021, which leads us to be concerned about where growth is going to come from as we head into hopefully a better year than what we have this year. So, hopefully we get there. But now in the next segment, we're going to go through the Europe in a bit more in terms of what's happening within the European Union.